Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Raymond Jang, welcome to this episode of the Australian Investors Podcast, mate.
Yeah, it's great to be here.
Filming in person.
Yeah, in Sydney. So what are you doing down in Sydney?
Your home ground, mate. Your home ground.
Yeah. The weather's turned it on as well. So.
Yeah. I heard earlier this year that basically we swapped, Melbourne and Sydney swapped weather. You guys got heaps of rain. We got some sun, but it was very cold. So now I've come up to Sydney and you've turned it on for me. So thank you.
Yeah, timing is perfect. So
timing is everything.
Yes.
In investing as in life, by the sound of it.
So very hard to do, almost impossible, but Sydney's done it for you. So
yeah, well, thank you. What have you been doing lately, mate? What have you been working on?
The last major task I did was a massive research piece for Claude, his A Rich Life. Did a piece on Lovisa.
Yep.
Very interesting company. Something that I think is outside my flywheel because it's a product for females, but it was really good to get stuck into a high quality management team and really look at all the retail competitors as well. It was a bit of fun. Yeah,
well, we did the podcast on it not too long ago, and I know you did the write-up for Claude on A Rich Life, and Twitter loved it. Twitter was abuzz with your write-up, so you must be doing something right, which is great.
Yeah, I really enjoyed it. It was good fun.
Yeah. If you're listening to this or watching and you want us to cover a particular company or industry or something, please write into us, podcast@rask.com.au, and Raymond and I can take a look at it. It's great if we can have some interesting companies that no one's heard of. If you want us to take a look, I got a message earlier this morning about Horizon, which is the rail network business. I've never looked at that business. So that's one that we can maybe talk about in the future. But
what's the ticker code?
Oh, you're testing me. I'm going to say it's AZJ. Let's have a look. ASX AZJ. I'm just punching it into Google. Yep, that's the one. Horizon Holdings Limited. There you go. That's how much I know. So actually, we had to do a study on Horizon, which was QR National, I believe, before this.
Yeah.
And we went at uni. We had to basically figure out, like, according to like regulation that set prices on the rail networks, what impact that would have on the valuation of the company. I don't know how I got through that subject, but I did. And it was an interesting case study, but that's about as close as I've got. So maybe we can look at that in the future. So today we're going to talk about two companies. We're going to talk about Supply Network, which is SNL. That's the ticker symbol.
Yep.
And we're going to talk about National Tyre and Wheel, which is NTD. Supply Network is truck and bus parts. Is that correct?
That's right.
Yeah. And National Tyre and Wheel does tyre and wheels, surprisingly. And we're going to talk about like the origin story, the business overview, talk about management, some of the risks, and basically what we found looking at those businesses. And then you, dear listener, can make the decision of whether you like either of the businesses or one or the other. I think we just talked off air about which one's more interesting. But hey, there was something that I messaged to you the other day on Slack, which is just a bit of a trend in the data that I saw. This episode, by the way, is powered by Selfwealth, our official broker sponsor of the Australian Investors Podcast. So shout out to Selfwealth. And they actually did their year-end review data, which is where they look at all the trades from all Selfwealth users, about 120,000 of them. And there's heaps of data that they collect. And one of the pieces of data that I was interested in is the difference between ETF investors and stock investors. And the top 20 stocks inside Selfwealth, there was $6.3 billion of shares that traded hands, or changed hands, I should say.
It's a massive amount.
Massive amount, right? Now, there were, of the top 10 ETFs, there was 2.9 billion. So 2.9 billion for ETFs, 6.3 billion for shares. But the interesting part to me was year over year. So year over year, the top 10 ETFs went from 2.1 billion to 2.9 billion of traded value. So is that 30% growth, or just under? For shares, which is a figure I didn't tell you off but before recording today, mate. For shares, they went from 5.8 billion to 6.3 billion. So not nearly the same amount of growth, but more in value.
Yeah.
And this kind of raises I guess it highlights something to me that I think I'm seeing in a lot of data is that a lot of investors are turning towards ETFs more and more. The thing that maybe flies in the face of that thesis is the average trade value for the top 10 ETF is $14,000, whereas the top 20 shares is $28,000. However, in those ETFs, there's inverse ETFs and negative and geared ETFs. So I'll give the 5 most popular ETFs in Australia of 2020, of FY22, which was the Vanguard VAS ETF, the Strong Bear ETF from BetaShares, BBOZ, the Gear ETF, which is a leveraged ETF, VGS is Global Shares from Vanguard, and VDHG, which is the Diversified Fund. The 5 most popular shares were Fortescue, Westpac, ANZ, Combank, and of course BHP. You'd expect them. I didn't expect Fortescue to be at the top though.
Yeah, it's done quite well.
Yeah.
I think over the last maybe decade.
Yeah. It's been crazy. Yeah. It's over the last decade, Fortescue's almost gone bust and then turned into a monster.
Yeah.
Like it's just the dividends that it's paid with iron ore prices being so high. $804 million, was that $million? $804 million of traded value in Fortescue shares through self-wealth alone, which is pretty interesting. But anyway, I think this is, I think if I could stare into my crystal ball, I reckon for ETFs, all the data is pointing to more and more and more value getting poured into them, which makes sense because they're diversified in one go. So you can build a core portfolio out of low-cost ETFs, and then you can have your individual shares and your active strategies around the outside. So interesting. We'll see what happens in the next 12 months. But for now, really interesting to see ETFs still powering portfolios. Mate, let's talk about some companies. Do you want to go first or shall I?
Up to you, Owen. I'm happy to talk about Supply Network.
Okay.
If you don't feel like talking about Tyres.
Okay. Who doesn't love to talk about Tyres? Why don't you go first? And while you're talking, I'm going to pull up on my computer here. I'm going to pull up some data on Supply Network, and hopefully we can keep the conversation going from there. So, what is Supply Network? How did it start?
Yeah, so Supply Network is a very interesting company. It was founded by Harry Forsyth back in 1970. So it's got a really long history. And he simply started selling spare parts to one of the biggest bus manufacturers. I'm not sure if you know the name, Leyland Buses.
Yeah, I've heard of it.
Okay.
I feel like I have, yeah.
Yeah. Well, you're older than me, so that might explain.
I look a lot older than you.
But yeah, so if you notice the double-decker buses, the really old vintage buses, that's what Leyland manufactured. And he really focused on selling spare parts to that bus manufacturer, and then it listed in 1987. And it's also selling truck spare parts now, and that's driving a lot of the recent growth, especially in the last 5 years. As to what it actually does, it sells truck and bus spare parts. So when you think of fleet management providers and bus fleet operators, if the bus or truck breaks down, they need to go back to the repairer or back to the depot. They might have an in-house team, and they need to get the truck or bus on the road. And it's really important for them to get the truck or bus back on the road because time is money. Time is of the essence for those companies. And from the repairer's perspective, it's really important to get that spare part really quickly in time. And have a guess how many spare parts go into building an actual truck.
Jeez, I wouldn't know because I don't know. I feel like this is one of these numbers that is just like so unbelievable because the way you're setting this up, I'm like, I don't know. I'm going to guess 2,000.
That's that's just the number of parts that goes into building the engine.
Oh, wow.
So the actual truck itself, there's 30,000 individual spare parts. So it just
Wow.
shows you like how many little pieces actually goes into building the truck.
Yeah, wow.
So it's not your typical Lego piece where you put a couple of blocks
They're only
together
different colours.
and put some wheels on the bottom, as you usually do with Lego.
So can you think of this company like Bapcor?
Yeah,
Which is
exactly.
like Burson? Yeah.
Yeah, Bapcor is one of the competitors. Bapcor is much more focused on the commercial vehicles.
Yeah.
And also they run the Autobahn stores.
Yeah, retail.
Yeah, retail focus. And that probably explains why the return on assets is lower than Supply Network, because they have to spend much more money on marketing to reel in those retail customers.
Yeah. Yeah. And so, okay, so the business has been around for a long time. How big is it?
In terms of market cap, it's roughly $400 million at the moment, and revenue has grown quite a lot. So you have Supply Network, you have Bapcor, and then you have a third competitor called Maxi Parts. Maxi Parts is more focused on manufacturing the actual trucks, trailers, tippers, and vans. Tippers, as in those massive yellow,
Tonka truck
mining,
looking
yeah,
things.
yeah, those trucks. So that's why their gross margin's a bit lower, because they have to incur a lot of costs in actually manufacturing and sourcing the materials to build those vehicles. So aftermarket spare parts makes up a small portion of their revenue, and so those three players probably take around 30% of total market share in the aftermarket parts space. So I think moving forward, especially in the current macroeconomic environment with rising inflation, rising interest rates, you'll see these bigger players have a stronger balance sheet and also a bigger scale, a bigger network. And I think they will naturally, over time, this oligopoly structure will do well over the long term. Yeah.
How about management then? So, because I've got to admit, everyone, that I did actually read Raymond's write-up. So he's done a write-up for Rask before the show, which is what initially made me so interested, because I'd always looked at it and thought Supply Network, it sounds like, to be honest, it doesn't sound like the type of thing that I'm going to invest in. But the more I've learned about it, the more impressive it is. And I feel like management's a key, like it's worthy of like a point in itself.
Management is the actual executives it's a very unique set of executives. I think I haven't come across a management team like this from reviewing a lot of ASX companies. I was reading a book called Good to Great by Jim Collins, and he mentions how the best leaders actually are not obsessed about their celebrity status and talking about themselves. And when you see annual reports where they often use we in talking about their achievements, and you see that, you see that a lot in the annual reports. And another very interesting thing I noticed was that every single annual report that you see nowadays, in particular, you see a lot of photos. It's very glossy. The Supply Network is absolutely opposite. They don't even have photos for the executive team. So it just shows that, they're not really focused about, their own personal brand. It's more about the company itself. And that's probably why the executive team has stayed around for, I think the average tenure for the executive management team is 16 years, which is a bloody long time when you talk about careers. Staying in the one job for that.
And that's the average, right? There'll be people that stayed a lot longer than that.
Well, CEO, so he's been around for 22 years. And the founder, Harry Forsyth, has still owns 30% of the company. So,
okay.
And when you talk
so there's a lot of alignment, right?
Yeah, when you talk about performance measures, it's very well aligned because they're focused on total shareholder return. second being average return on equity, and the third one is return on investment. And I think those measures have led to very sound capital allocation. And you can see that from the rate of return on diluted earnings per share over a very long period of time, because they've spent so much time trying to improve their supply chain efficiencies. For example, they were using third-party delivery drivers to deliver that final, spare part from the distribution center to the retailer and then to the end consumer. And they weren't happy with the standards of the third-party delivery drivers, so they decided to take it upon themselves and bring everything in-house. So it's vertically integrated. And over 15, 20 years, they know what works and what doesn't. So I think this quote by the management team in the 2019 annual report sums up, their approach and why they've been so successful. They said there is no single game changer for our industry, and our plans for profitable growth continue to be built on many small steps that improve service levels and operating efficiency. And I think they've just, it's a boring company, boring industry, but they've excelled at, what they do best is to provide the best possible range of spare parts and doing it very efficiently and getting it at the best price.
Yeah, you said that it's a lot of small steps, right?
Yeah.
The return on capital, I'm just looking in the ticker terminal now. On the return on capital is currently around about 26%, but it's been over 20%, as high as 34% for basically 9 out of the past 10 years. So this is a business that, is compounding really fast internally. How have they done that? Is that from more distribution centers? How have they grown so fast?
I think a big reason for that is the knowledge that they've built over a very long period of time, because spare parts, there's so many different spare parts. So the staff member at supply networks, they really need to know what specific spare part that is needed to be provided to the repairer. And when you build a really strong culture and very knowledgeable team over a long period of time, that provides a really big barrier to entry and a big competitive advantage over competitors, because they've been doing it for the last 35 years since they listed. So that equips them with the knowledge to really provide exceptional customer service and providing the parts as quickly as possible. Because at the end of the day, I think because they're really just distributing the end product, it's all about optimizing efficiency and providing the best possible customer service. So yeah.
Okay. So how do you think about the risks? What are the risks of supply network then?
The immediate risks that come to mind include rising inflation. We've seen material, energy, and shipping costs rise, and management have flagged that it has increased 5 to 10%. But in their most recent update, they said they've been able to pass on those costs. But I think it's something to be wary of moving forward, and to keep a mind of whether or not it's structural and it'll affect operating margins moving forward. So I think that needs to be worked into your valuation. Another big risk would be supply chain risk, because they're essentially in the supply chain industry. So any delays in getting parts to Australia might lead repairers to rely on independent stores rather than supply network. So there could be lost revenue or lost opportunities from not optimizing the supply chain.
I guess those are risks that people could monitor. I was just looking at the gross profit margin and over time, and it's been pretty resilient. So like over 40%. And I guess like supply chain, you could monitor those types of things through, I guess, through things like return on invested capital, or you could listen to management's commentary, how fast the top line is growing, et cetera, et cetera. Passing on costs is actually something that's really important to a lot of companies. And we're finding out now with inflation so high globally, how many companies actually have pricing power, which is interesting to see. And the company that I'm about to talk to seems to have not been able to pass on all the costs. So it has suffered. We'll get to that in a second. Okay, so we don't necessarily have to go into super detail here, but how did you go about valuing Supply Network?
Yeah, so I completed a traditional discounted cash flow, but it was a reversal of that. So I was trying to understand what the current share price. At the time, it was hovering around $9.50. I think it's $10 at the moment.
Yep.
I think it's reasonably priced because it's management's been guiding revenue growth of 12% over the next few years. And management have had a history of under-promising and over-delivering. So I think, based on a reverse discounted cash flow, I think it's not aggressive assumptions that need to be made to generate that kind of return. So it's probably fairly priced. And when you look at on a relative basis, I think it's the price to earnings is around 20 times at the moment. And that's been the average since it's listed. So, and then you look at the historical price to earnings multiple for the all odds index, which is around 17 times. It's, would you put Supply Network, in the category of an average company within the ASX?
Not if it's compounding that fast.
Yeah. My opinion, based on the management team and the quality of the business, it's probably deserves a bit more premium. So through those two lenses, I think it's reasonably priced. But obviously, I would prefer to invest in it at a cheaper price.
Yeah. It sounds like it's kind of like I feel like it's like a vanilla business for a lot of people. So I think most people could probably wrap their head around what it actually does. It's just an anecdote. I was on the Gold Coast a couple of weeks ago, and I was talking to the cab driver who said he used to do the driving for a auto store, or auto parts store. And he said Bapcor, like Burson, opened up. And basically, like, that family business closed down as soon as Burson was in the area. And he also said that Repco is like the key competitor and has had to really step up their game in the areas where Burson has arrived. And so I feel like Supply Network is kind of like doing maybe something similar, but in truck and bus parts, which is pretty powerful. And these are pretty, like, traditionally, these are pretty defensive businesses too, right? Because you don't need less parts just because the economy has taken a downturn. You might substitute parts or something like that, but you're still going to go to the lowest cost provider, right?
Yeah, I think it also comes down to the strength of the relationships with the suppliers as well. I think they've really harnessed and fostered really good relationships with their key suppliers. I think over time there's a couple of industry growth drivers as well. Like you have a big shift to EV vehicles, so a lot more mining trucks are transporting minerals to provide the minerals and resources. So once those trucks wear and tear over time, then they'll need replacement parts. And also there's more technology being embedded in the trucks and buses because you're trying to optimize engine efficiency, making it more safe, as well as reducing emissions. So that's another growth catalyst there.
One thing I like to do, and I talked about return on capital before, one thing I like to do is also look at return on capital and plot that against shares outstanding, because the shares outstanding actually give you a sense of if the company is issuing capital, like issuing equity capital, can it maintain You can probably hear the bus go past just now. Probably needs a part. Needs to go to supply network and get a part. I guess plotting the shares outstanding and return on capital just gives you a sense of how they're funding the business, if they've been super dilutive, if they've made acquisitions and so on and so forth. But yeah, I mean, it's a really interesting business, and it's really, it pays a dividend too. So like a modest dividend, which is kind of cool, which you'd expect it to with so much insider ownership. Typically smaller to mid-cap companies that have such high insider ownership, the founders or CEOs and that, they love to get paid. So especially fully franked dividends. So it's a good business. Do you own it?
No. But looking to, really take action once there's any dislocation in the value.
Once we see a dislocation of the price to value ratio, I like it, mate. That's Supply Network SNL. So it's a good, it's a good one. It's a good pitch.
Yeah.
You're very chilled out when you're given it. It's kind of cool. I like it. National Tyre and Wheel, NTD, NTAW.
Also in the same space. So we're just talking about vehicles all day.
When they merge, they should merge. I feel like Supply Network would not go for that. So I'll give a bit of a story on National Tyre and Wheel. So National Tyre and Wheel, which is NTD on the ASX, it's actually kind of like it's a bit of a interesting business because from the perspective of it's not today what it was many years ago or even just a few years ago. So the business didn't IPO that long ago, but the business is kind of tracing its roots back to 1989 when a guy called Terry Smith identified a need for 4x4 tyres in Australia, principally 4x4 tyres. So if you know Micky Thompson or you know Cooper Tyres, these are both two brands that were exclusively sold through, I guess, the Origin business. And what had basically happened over that time is in around about 2012, 2013, a guy called Peter Ludeman jumped into that business and then took over as CEO. And his background was private equity and dealing with companies through acquisitions and so on and so forth. And from that point on, the business morphed from just selling exclusive tyres on 4x4 and they started to think, well, maybe we can make acquisitions. The actual industry itself, which I'll get to in a minute, is very interesting how it's made up. So most tyres are made in Asia and then they're brought to Australia. And one of the interesting things is that the cost of a tyre, I think, is the stat is roughly 30% of the cost of a tyre is in commodities, so like rubber, oil, so on and so forth. So that's actually one risk to tyre distributors and original tyre, I guess, manufacturers, is the cost of a tyre. And interestingly, like people probably think, just as I'll quickly push this out, is just that one of the things that I thought was like, oh, well, autonomous and electric vehicles, do they use tyres at the same rate that regular combustion engines do? And yeah, the answer is yes, and sometimes more. So I think that's just to clear that kind of ground, is like, is that a threat to this industry? But if you look at the prospectus of National Tyre and Wheel, it's super informative of how the tyre industry works. And I've got the chart in front of me. I'm going to try and explain it for people that are listening. But basically, you can think of like global brands like Bridgestone, Goodyear, Michelin. Those three brands, Goodyear, Bridgestone, and Michelin, are actually vertically integrated. So that means they're not just offshore producers of tyres, but they also do the distribution and the retail. So you've probably driven past a Goodyear, a Bridgestone, or a Michelin outlet. And then there are other really, really popular brands in Australia and globally: Cooper, International, Yokohama, Kumho, Toyo, Pirelli, and Hankook. These are the big manufacturers. Then there's like those cheap knockoffs you can get, which are like a half the price and they last you a third of the time.
I had a bad experience with one of those tyres. I thought I'd be able to get them on the cheap, but it only lasted me 6 months.
Oh, right. Okay. Yeah, well, that happens, right? And I think, oh, what a waste as well, right? Like rubber. It's actually kind of interesting because when you think about it, the size of your handprint is basically what touches the road. And so the big push for quality tyres is, if all that protects you and your family from spinning off the road is a handprint. You want to know that that rubber is good and that tire is good. And a good set of tires does last forever. Like I got some Pirellis on my Subaru.
Oh, yes.
Yeah, it's
I got Pirellis now as well.
Yeah,
so
jeez, upgrade.
feeling the difference.
Look at feeling the difference. Look at us go. So we've got these different brands. Now, when National Tyre was exclusive tyre, basically what happened is the business signed a long-term contract with a long-term exclusive deal under Terry Smith with the brands Micky Thompson and Cooper's. And for those people that aren't 4x4 enthusiasts, Micky Thompson and Cooper's are pretty reliable tyres in Australia. Like if you're driving a 4x4, there's a pretty good chance you've got that on there. And so he saw that the industry was taking off and blah, blah, blah. He got in, got this deal. And then he started to distribute. And that was a real growth driver of the business. And it wasn't that long ago, even today, after many acquisitions, that National Tyre, I think, did about a quarter of its business just through those brands. So a quarter of its business was driven by those two brands, which if you're an outside investor and you're thinking, oh, okay, that's a bit of concentration risk on one supplier, and also the exclusive rights. So if you go to a store and you want to put particular tyres on, they could buy them in if they are able to, but if they're not, then you might have to go to another retailer. So National Tyre, until recently, which I'll explain, was not the tyre retailer. It only did the distribution, bringing the tyres in, shipped them to clients. And so if you think about it, there's this whole side of what we know as consumers, which are like the resellers and the servicing side of the tyre industry. So here we've got Goodyear, Bridgestone, Michelin, and Hankook / Jacks, but we also have Tyre Power, Bob Jane, Kmart, and there's all the smaller brands as well. Where National Tyre sits in all of this is it's an independent tyre distributor. So it can source tyres from just about anyone and then distribute them to just about anyone. And that's a kind of the proposition. Since the IPO, National Tyre has actually made a series of massive acquisitions. The first was Tyres for You, and Tyres for You was almost like a reverse takeover because it was a bigger business. Tyres for You had also just bought, I think it was Tyre and Tube, which is another big distributor, just before National Tyre bought that. So like all three of them are basically under one banner now. And since then, and you raised the point before that National Tyre has bought again, it's made more acquisitions. It's bought Carter's, it's bought Black Rubber. And over time, what is the result of that type of business model? Well, from a business and operating perspective, what National Tyre's model is there are all these fantastic operators out there that have these independent brands and distribution businesses, and even some of them had retail elements as well. We'll bring them into the National Tyre umbrella, but we'll let them operate as the standalone businesses, kind of like the old Buffett, just let them run themselves, or Constellation Software, just let them run. And that sounds like a great model because then you can bring management into the fray so they understand their business while also giving them support in other ways. So maybe different tyres, consolidate the back end. So what they're currently doing is they're currently consolidating their warehouses, which should save them a few $1 million a year because they've got operations all over Australia, New Zealand, South Africa, I believe. So that's one of the synergies. And in many respects, this is a roll-up of tyre distributors. So it's like that I'll be there for a good time, not a long time. I made a mistake with that. I've been there for a long time. So we recently moved this to a hold, by the way, just to cut to the chase. We moved it to a hold away from a buy for a few of the risks that I'm about to mention. And anyway, so the business today has a guy called Peter Ludeman, who's the CEO, the private equity background, owns quite a few shares in the company. Terry Smith is still on the board. He owns a lot of shares in the company. And so do many of the executives that sold into the business. But you raised a point before, mate. What did you say the multiple of Carter's was when they made that acquisition?
It was 14 times EBITDA, I think.
Yeah, right. Okay. So 14 times EBITDA. And you said that kind of put the hairs up on the back of your neck.
Yeah. I think I do get a bit worried where I think it's probably more important to focus on, what How much cash are the new businesses, actually bringing in, and what's the value creation from this acquisition? Because $30 million is not cheap, I think.
Yeah, there are quite a few acquisitions, and I think one of the excuses we could say may be that during Corona and all that, many businesses were affected, and so maybe there was depressed EBITDA. So the multiple looks stretched, but maybe a normalized basis, it wasn't as big. They made another acquisition, which was a company called Black Rubber. And this business, as the name might suggest, actually brings something else to the National Tyre Wheel network, which is Black Rubber brings a whole heap of services like tyre retreading. And so the ability to retread tyres saves money, saves the environment. It's a much better way to do things. And so that kind of expertise and know-how and network then can be applied to all of the other national tyre facilities. So then basically you have the synergies of saving money, but also creating value. Yeah. And so
improving that customer service.
Yeah, that's it. And then they can serve, one of the things that they have done with a bunch of these acquisitions is trying to go direct to business, so to fleet managers that you mentioned before, like bus, trucks, agricultural, mining, whatever, go direct. And then you can actually sell customers or clients on a cents per kilometre basis rather than just like, okay, it needs to be replaced, let's do it. It's actually more like a contracted type style model. But the result, just circling back to the acquisition multiple before, if I was to see 14 times EBITDA for a tyre distributor that maybe might grow at GDP plus 1 or 2%, I think, wow, that's pretty exy. Unless there's some serious synergy to come out of the back end, that's overs. You're paying a lot for that. And I think what we've known and what I've known for quite some time is that typically in a roll-up business, what you want to see is you want to see the company that's doing the rolling up, so the bigger company, to have a really stretched valuation. So like a price to earnings ratio of 20 times, EV to EBITDA of 10 times, say. Because then what you can do is you can issue your shares at, if it's a P ratio of 20, that's an earnings yield, or E divided by P, of 5%. So that's basically what you're giving up. You can issue your shares and make an acquisition of a private business that might be cheaper. So you've got that private to public arbitrage. Now, National Tyre hasn't been able to do that. It's issued some capital recently, but its valuation has always been very low. So let me just have a look here. The company's return on capital, just while I've got it up on my screen, in the most recent 12 months, so June 30, 2021, was 19%. And this was in an abnormal year. Everything that was extraneous, everything that external was positive. So keep that in mind when I quote that number. But if I bring up some other numbers here and I look at the balance sheet, over time, the total debt of this business has gone from, in 2016, $3 million up to $80 plus million currently. So it is basically maxed out its balance sheet. And the reason why is that the debt capital markets were more efficient than the equity capital markets. The problem that you have is in a business that doesn't have great margins, that uses leverage, it actually gets riskier the more debt it takes on. So that's why equity is often the preferred option, because equity holders can't say, hey, I want my equity money back. I want my face value back.
There's no interest on it. So.
That's it. Yeah. So it's not a legal contract that you get all of your money that you invested, whereas with debt and bonds it is. So the National Tyre business has actually got more expensive, I would say more risky over the last few years. And it hasn't fully benefited from the increase in valuation. So that's one thing I'm mindful of, and it's one of the risks that everyone should be aware of as they listen to this. The other thing is, so the current trailing enterprise value to EBITDA is 6 times. The way roll-ups work is, I've found, is when they add value. So you have to know your payback period, and you have to know, like, is there incremental gains? Can you do something to that business that it can't do by itself? And one of the things that's happened with National Tyre is it hasn't actually extracted value. So they're trying to roll out an ERP, enterprise resource on Microsoft. That's been delayed. They're consolidating some of the back end through the warehouses. They've got cross-sell opportunities. And by making more acquisitions, they've actually de-risked their business because they're less dependent on Cooper. Because Cooper, I should mention this, is actually really important. Cooper was acquired by Goodyear. So that basically took Cooper into a business that is vertically integrated. Now, National Tyre has been able to sell Cooper through the exclusive distribution, but it also sells into Goodyear stores as well, I believe. I think you can get products there too. So there is a bit of blurring of the lines, but for the most part, the contract should remain in place for a little while. At least that's what shareholders are hoping. So I feel like I've fed everyone an overload of information on National Tyre. Have I covered everything, or is there something else?
I think that's a lot of very important information. I think your point about the acquisition strategy and the risk behind that, and that being driven by a lot of debt, that's a pertinent point, something to keep a mind of.
There's actually one other part. Is they come out with an update. We're recording this on July 29, 2022. There's actually an update. I think it was earlier this week, actually. Maybe it was late last week. They come out and said that they give out their second half guidance. Before reporting season, you have confession season, and that's basically what we're in at the moment up until August. And it looks like, based on the numbers that I was trying to back out, it looks like that the business is organically going backwards. So even with acquisitions, it's not, it hasn't proven recently that they've been able to get those gains out of business. So here's what I wrote to members recently. I said, I hope I'm right here. In other words, National Tyre will add $90 million of revenue this year, but lose $5 million of operating profits from last year. So they're adding revenue, but it isn't creating that much value because they aren't extracting the synergies that they thought. And that's because currencies have moved against them. It's because they haven't been able to generate the free cash flow because they're getting hit by inflation and rising prices. They did in the first half of the financial year, they did say that they had 2 price increases that they'd pushed through, and they were planning to push more through, but I don't know how well they were received. Obviously, if we just look at the business and what it's saying, is that it's copped a hit there. So,
and on the flip side, it might take some time for them to achieve those operating efficiencies and improving customer service levels as well. I think, we talked about supply network. They've been doing, the same thing over 35 years. So maybe those value opportunities might arise later in the stage. And it's something that as an investor, you have to weigh up.
Yeah, you do. Yeah. You do. And I think what happens, particularly in small caps, is many investors, when they think about investing, if you give me 3 reasons to buy National Tyre, they'll come up and they'll say these 3 reasons. Then you say, okay, give me 3 reasons to sell it. They become paralyzed because all of a sudden the negative overwhelms the positive. And we tend to do that as investors. We jump onto Twitter or we go onto wherever and we get our source of news, the AFR, whatever, and we get freaked out and we sell. And I think one of the things that you can talk about this through the lens of anti-fragile, so companies that don't break very easily. But I think most investors need to remember that companies aren't static. They're not glass. They bend as well. They don't just break. Some companies do for sure. But most companies are organizations that if things go bad, they adjust, they readjust, and they don't want to go out of business. And so what that means is that as an investor, you sometimes have to be more patient with some companies. Now, that said, I think the risk has turned up on National Tyre, and I think high inflation is hurting it. And I think some of the things have, like supply chains and whatever, have gone in reverse, where they were very positive a couple of years ago. So you have to understand how a company operates in a new macro environment. To be honest, I think the free cash flow that the business was generating 1 to 2 years ago is probably not going to be repeated anytime soon. That said, depending on how, I modeled it through DCF, but also through ratios or multiples, and I can get to the current price, which is around about, depending on when you're listening to this, probably between 90 cents and $1. You can get to that valuation, and you would probably do that with around about a 12, in my opinion, a 12%, 13% discount rate, when it probably needs to be a bit higher than that now because of the risk. So if you increase your discount rate to say 15%, aka your expected return, you might be looking at something in the 60 to 70 cents range. I think the big thing for investors, and I mentioned this off air before, is dividends. Dividends need cash flow. So if you just think about the cash flow of the business, and cash flow relies on margins and revenue. And if the company can continue even just at like current pace and it can turn, a decent operating EBITDA is what they call it, they could be capable of paying a dividend and paying down debt. And I think they'd want to because they've got a lot of aligned directors and management. So that's normally a sign that they want to pay dividends because they want fully franked dividends. They want that stuff as much as an individual shareholder. So if they do that, that could underwrite a valuation. Like I could put a floor on it. And there are still many other levers like cost outs and so on and so forth that the business could be capable of. It's I'm going to put this on record and say it's probably not an acquisition target, and then I'll probably go and get a takeover offer. But I think that's something that can also underwrite the floor price. So do I think it's capable of beating the market? Yes, maybe if it pays a dividend.
Yeah.
What would I take over this or Supply Network right now? Probably Supply Network. I just think it's a bit higher quality. It's a bit better insulated with wider margins, long-term track record and so on. So I'd probably want to do more research on the industry for Supply Network before I got really comfortable with it. With National Tyre and Wheel, it's a potential yield stock, but it's a higher risk yield stock is probably how I'd summarize it. Yeah. What about you? What would you take?
I think that's a very fair summary of National Tyres. It's high risk yield stock. And I'm more of a conservative investor. So I think over the time, I've become much more enamored with the more resilient businesses and with really high quality management teams with a really strong track record. So that's probably the main reasons why I would go with Supply Network. And having done the research into the industry dynamics, and you make a good point about when you account for the negatives, you tend to become very pessimistic. But after listening to the contrary views for Supply Network, it does strengthen my thesis for it. I think it's a much more well insulated industry and business.
Yeah, great. I agree. I think it's a really high quality business. So I like it. For those listeners who want to learn more about these businesses, I think we should be able to share your write-up, or maybe you can do one on Supply Network if you want to get your head around the business. Raymond's done a fantastic write-up on that. But if you want us to do more episodes just like this, where we dive deep into some stocks, please write into us, podcast@rask.com.au, or just hit us up on social media. Is it
Jang _?
I always get the underscore. I always think the underscore's first. So Jang _ on Twitter. Yeah. Links will be in the show notes, as are mine. Mate, and people can, is that the best place to reach out to you if they want to reach out to you? Is it Twitter?
Yeah, on Twitter.
Yeah, cool. Okay, we're quite avid users of Twitter. If you want to jump on there, you can say g'day, give us some feedback, tell us what you think about National Tyre or Supply Network. Raymond, mate, it's great to record in person.
Yeah, definitely. Had lots of fun.
Yeah, great. Thanks for joining me.
Thanks, mate.